1/4 of the entire national debt of America comes due in a single 12-month window. This is not a crisis for the next generation or a problem for the distant future. This is happening right now. $9 trillion must be rolled or refinanced or replaced, or the entire global financial machinery stops working. This situation is far more significant than annual deficits and more powerful than partisan politics and more urgent than any election cycle in history. There is no plan to pay this money back to the creditors. There never was a plan for repayment. What is unfolding in the year 2026 is not a simple default event. It is a moment of total structural exposure. We have reached a point where the entire financial system depends on constant refinancing and perfect liquidity and massive policy intervention. The real danger is not a sudden collapse of the markets. The danger is that this state of perpetual emergency becomes the new permanent reality. The reason why 2026 is so critical is not just the total size of the national debt. That number has been climbing for decades, and the global markets have learned to tolerate it. What changes the entire equation is when that debt actually matures. Time is now the ultimate constraint instead of the total balance. Out of roughly $38 trillion in outstanding federal debt, about $9 trillion matures in 2026 alone. That is more than 1/4 of the entire debt stock concentrated into a single refinancing window. Beyond the early 2030s, the maturity curve thins out in a dramatic way. The government no longer owes money that is spread smoothly across different generations. It owes money that is compressed into a few short months. This did not happen by accident or through bad luck. After the year 2020, the strategy for borrowing shifted aggressively toward the short end of the curve. Instead of locking in long-term funding at stable rates, the issuance tilted toward instruments that mature in weeks and months and a few short years. Treasury bills which mature in 4 to 52 weeks exploded in total volume. Short-term notes followed that same path. Long-term bonds became a much smaller share of the total debt stack. The debt did not go away or disappear. It simply moved much closer to the present moment. That shift is vital because debt that matures must be dealt with immediately and without delay. It does not wait for economic growth or productivity gains or future reforms in the tax code. When the date of maturity arrives, there are only two paths forward. You either repay it or you replace it. With annual tax receipts sitting around $5 trillion and total spending running closer to $7 trillion, the act of repayment is structurally impossible. The system is forced into a state of constant replacement. This is what experts call the maturity wall. It is not a cliff where the system falls off suddenly, but it is a narrowing corridor where timing risk replaces balance sheet risk. The government must show up to the markets again and week after week to refinance obligations that no longer sit safely in the distant future. That dependence on refinancing changes the very nature of financial risk. The question is no longer about whether the debt is too large. The question is whether it can always be rolled forward on terms that the system can handle. Liquidity and rate sensitivity and policy credibility now matter more than the headline debt figures. Once debt is trapped this close to maturity, the control shifts away from long-term planning and towards short-term conditions. This is why understanding who provides the refinancing is more important than the debt itself. Without continuous lenders, the wall stops being a theory and becomes a reality. Once debt is trapped against the pressure of time, the next great illusion collapses. That is the idea that this money will ever be paid back, in full. The maturity wall does not create a problem of repayment. It exposes the fact that repayment was never part of the design to begin with. The federal government currently collects roughly $5 trillion per year in total revenue. Total annual spending runs closer to $7 trillion, which means that deficits persist even before we consider a single dollar of the debt that is maturing. That gap alone requires about $2 trillion in new borrowing every year just to keep current operations running. Now you must layer on the $9 trillion that is coming due in 2026. There is no mathematical scenario where repayment exists inside these numbers. This is why the concept of paying back the debt is not a real policy goal. It is just a political phrase used for the public. Governments at this massive scale do not extinguish their debt. They simply replace it. When an obligation matures, it is settled by using newly issued obligations. Old debt only disappears because new debt takes its place immediately. The balance rolls forward instead of moving downward. That distinction is critical because replacement requires the continuous participation of lenders. Repayment would be a final act. Refinancing is a conditional act. It depends entirely on access and confidence and the smooth functioning of the markets. This transforms the problem from a simple math issue into a deep systemic issue. This replacement cycle is not optional for the government. Even if all spending were frozen tonight, the revenues could not absorb maturities of this magnitude. Raising taxes by trillions of dollars in a single year would collapse the entire economy before it could even close the gap. The system has no off-ramp left. This is the structural reality that is hiding behind the maturity wall. When debt comes due, the government does not look inward for savings or cuts. It looks outward for a rollover. Every maturity date becomes a high-stakes refinancing event. And every refinancing event tightens the dependence of the system on an uninterrupted flow of capital. Once repayment is revealed as a fiction, the real question shifts again. If debt can only survive through replacement, then the survival of the entire system rests on where that replacement funding comes from. It rests on whether that money can keep appearing automatically without friction or panic or negotiation. The system now stands on a single requirement. Replacement funding must always exist at any cost. The question is no longer about the ability to borrow, but the source of the borrowing. The answer to where the money comes from is almost never visible to the public. The largest lenders to the United States government are not foreign powers or hedge funds or dramatic bond vigilantes. They are automated pools of domestic cash that never make the headlines. The most important of these pools is the money market fund industry. As of mid-2025, the balances in money market funds sit around $7.5 trillion. That number alone nearly matches the $9 trillion that is rolling in the year 2026. These funds are not speculative tools. They are structural components of the modern financial system. Their mandate is very simple. They must preserve capital and maintain liquidity and earn a short-term yield for investors. To achieve that goal, they overwhelmingly buy treasury bills, which are securities that mature in a matter of weeks or months. When those bills mature, the entire process repeats itself automatically. Cash is returned, and then it is immediately redeployed into new bills. There is no vote and no decision and no drama involved. This is why the maturity wall does not trigger a visible scramble for new buyers. A massive portion of the debt rolling in 2026 is already embedded inside systems that are designed to re-lend by default. The government is essentially paying itself back with money that was never going to leave the system in the first place. Money market funds are only the most visible layer of this architecture. Cash balances inside brokerage accounts and retirement plans and pensions in corporate treasuries are all routinely swept into similar short-term instruments. Even traditional bank deposits do not sit idle in a vault. Banks use their excess reserves to buy treasuries directly, or they fund the institutions that do. Physical cash withdrawals would be required on a massive scale to break this loop. And those withdrawals occur at a scale that is far too small to matter to the federal government. This is the hidden architecture of the rollover. The lenders are not making a conscious choice to finance the government each year. The system is structured so that the financing happens automatically unless something fundamentally breaks in the plumbing. This is why liquidity crises do not start with debt maturities. They start when the intermediaries fail. But this mechanism creates a new and dangerous vulnerability. If refinancing depends on automated cash pools, then the stability of the entire debt structure depends on uninterrupted financial plumbing. Payment rails and settlement systems and collateral rules and central bank backstops become more important than economic growth itself. That brings the problem into a much sharper focus. If the lenders are invisible and automatic, then the real pressure point is not the availability of money. It is the price of that money. Even an infinite rollover machine becomes fragile when the cost of rolling that debt starts to rise beyond what the system can bear. If replacement funding depends on automated cash pools, then we must dismantle the next big misconception. That is the belief that money can actually leave the financial system. This idea is what fuels constant panic in the news. There is a fear that cash will suddenly abandon treasuries for stocks or gold or crypto or any other asset and starve the refinancing process. That fear completely misunderstands how money actually works in a modern economy. Cash does not flow into an asset, it moves between different owners. When someone buys equities, the dollars do not disappear from the financial system. They are simply transferred from the account of the buyer to the account of the seller. When someone buys gold, the exact same thing happens. Ownership of the asset changes hands, but the dollars remain inside the bank and brokerage ledgers. The total quantity of dollars does not shrink or relocate or opt out of the system. This matters because those dollars do not become inert once they change hands. They continue to exist inside institutions that are structurally designed to deploy idle balances into short-term government securities. Whether the buyer holds cash or stocks or bonds, the seller now holds the dollars. And those dollars are still rooted through the same financial infrastructure that supports the government debt. This is why asset booms do not drain the demand for treasuries. A stock market rally does not pull cash out of the system. It merely redistributes that cash. Once it is redistributed, the cash resumes its role as collateral or liquidity or reserve funding. Behind the scenes, it still finds its way back into treasury bills or reverse repos or money market instruments. The destination of the money changes, but the function of that money remains the same. This also explains why the concept of cash on the sidelines is so misleading. The system does not allow large pools of cash to sit idle for long. Brokerage sweep programs and corporate treasury management ensure that unused balances are continuously placed into short-duration government debt. At this scale, inactivity is not an option for financial institutions. Even extreme behavior by investors does not break this loop. If investors sell bonds to buy stocks, the seller of those stocks now holds the cash. If investors sell stocks to buy commodities, the commodity seller holds the cash. In every case, the dollars persist, and the institutions holding them are required to park excess liquidity in treasuries. The only theoretical way for cash to escape this cycle is through a mass conversion into physical currency or a permanent withdrawal from the entire banking system. That would require trillions of dollars in physical notes leaving digital ledgers simultaneously. Nothing in modern financial history suggests that this occurs outside of a total systemic collapse. Even then, the central banks respond by expanding liquidity instead of allowing it to vanish from the earth. This is why the rollover mechanism remains stable even during times of market turbulence. The concern is not whether the cash exists. It always exists somewhere. The concern is whether the terms under which that cash is recycled remain tolerable for the government. And that shifts our focus decisively toward the real danger. If money cannot escape the system, then the risk is not disappearance. It is price pressure. Because when trillions of dollars must roll continuously, even small changes in rates transform stability into massive strain. Once price becomes the main pressure point, the attention of the public usually goes to the wrong place. The popular fear is that rising interest rates will suddenly make the debt unpayable for the country. That framing misses where the actual exposure is located. The danger is not the long-term interest costs. It is the short-term sensitivity. The average interest rate on the entire federal debt stock is still only about 3.4%. That sounds manageable until you look at how that average is actually constructed. Treasury bills, which are the shortest maturity instruments, currently carry an average cost near 4.0%. Notes sit lower around 3.1%, and long bonds remain near 3.3%. The problem for the Treasury is not the average. It is the concentration of the debt. Long-term refinancing would be catastrophic at the current market rates. 30-year Treasuries yield close to 4.8%. 10-year yields hover near 4.1%. Rolling large volumes of maturing debt into those long maturities would lock in interest costs that are 25 to 40% higher than what the government pays today. That would permanently raise the annual interest expense by hundreds of billions of dollars. But that is not what is currently happening. The refinancing wave approaching 2026 is dominated by short-term instruments instead of long bonds. Bills mature quickly, but they also reset their price quickly. That distinction changes everything. When short-term rates fall even modestly, the impact on the budget is immediate. A 50 basis point reduction applied across trillions of dollars in rolling bills translates into tens of billions in annual interest relief without issuing a single long-dated security. This is why the interest time bomb is so often misunderstood. The bomb is not ticking at the long end of the curve. It is wired directly into the short end. Short-term debt magnifies every policy decision. It converts central bank rate adjustments into instant fiscal consequences for the nation. When rates rise, the costs spike rapidly. When rates fall, the relief arrives just as fast. That sensitivity explains the relentless pressure on monetary policy today. Central banks do not need to control 30-year yields to stabilize the finances of the government. They only need to influence the front end of the curve. Bills respond first, and they respond fully, and they dominate the rollover calendar. This also explains why fears of an immediate debt spiral are premature. As long as the refinancing stays short, the system avoids locking in the higher long-term rates of today. Interest costs remain flexible instead of being fixed for decades. The risk is delayed, but it is not eliminated. But flexibility cuts both ways. A structure that depends on constant short-term refinancing trades long-term stability for immediate exposure. The system becomes less vulnerable to long-term rate mistakes and more vulnerable to policy failure. Because once debt is positioned to reset continuously, the only thing standing between control and a crisis is the willingness and ability of the central bank to intervene in the markets. That leads directly to the real strategy underlying the entire shift in maturity. Debt has not been shortened just to survive the markets. It has been shortened to stay reachable by policy. Once interest sensitivity is understood, the structure stops looking like an accident. The debt was not pushed into the short term because it was convenient for the Treasury. It was pushed there because it was controllable. Short-duration debt is the only part of the curve that reliably responds to central bank policy. Central banks do not set the 30-year borrowing costs for the world. They influence overnight rates and repo conditions and reserve availability at the front end. Treasury bills sit directly in that zone of influence. When policy moves, the bills reprice almost immediately. Notes follow much more slowly. Long bonds often resist the change. This creates a powerful incentive for the government. If trillions must be refinanced anyway, then issuing debt that resets in weeks or months preserves the optionality of the state. A government locked into long-term debt at 4.8% has zero flexibility. A government rolling bills at 3.6% with maturities measured in days can wait and adjust and reprice continuously. Time becomes a tool for the state instead of a constraint. That is why the issuance shifted so aggressively after the year 2020. As inflation surged and long-term yields broke higher, locking in decades of elevated borrowing costs would have permanently inflated the interest expenses of the country. Instead, the issuance leaned toward instruments maturing in less than 1 year and short notes maturing in 2 years or less. The maturity wall forming in 2026 is the delayed consequence of that specific choice. Short-term concentration also turns rate cuts into massive fiscal leverage. A single 100 basis point reduction at the front end applied across trillions of rolling bills produces immediate relief. This relief is measured in tens of billions of dollars per year. It requires no tax increases and no spending cuts and no legislative action from Congress. It is just a rollover at lower rates. This is why policy debates focus so obsessively on near-term rate paths rather than long-term fiscal reform. The debt structure has been engineered so that survival depends on short-end conditions instead of generational solvency. The system does not need economic growth miracles to survive. It needs continuous access to low-cost short-term funding. But this strategy comes with a cost that compounds in silence. Short-term debt eliminates all insulation. It removes the buffer that long-dated financing once provided to the Treasury. Every rate decision now feeds directly into the finances of the government with minimal delay. Stability becomes conditional on the next meeting. Errors become amplified across the entire economy. This is the trade that has been made by the leaders. Long-term certainty has been exchanged for short-term flexibility. Control today has been purchased by surrendering the resilience of tomorrow. The system can adapt quickly, but only as long as the policy tools remain effective and trusted by the public. That is the key vulnerability of the entire machine. Once debt is positioned to reset constantly, the government is no longer insulated from policy constraints. It becomes completely dependent on them. Rate cuts are no longer just stimulus tools for the economy. They are maintenance tools for the debt. This brings the real risk into full view for everyone. If the system requires perpetual policy support to remain stable, then the danger is not markets rejecting the debt of the country. It is what happens when policy loses the ability to keep up with the demands of the wall. Once debt is engineered to reset constantly, the system crosses a line that cannot be easily uncrossed. Stability no longer comes from strong balance sheets or long-term planning. It comes from constant intervention. Intervention stops being a tool of choice and becomes a structural requirement for survival. Short-term concentration means the government is no longer insulated from its own policy limits. Every refinancing cycle ties fiscal survival to the ability of the central bank to manage rates and liquidity in real time. When trillions of dollars roll every few months, there is no margin for hesitation or doubt. Policy must always be present, and it must be credible, and it must be effective. This is where the real risk lives for the future. It is not found in the default headlines, but in the state of permanent dependence. Rate cuts are no longer discretionary responses to a weak economy. They become structural maintenance for the Treasury. Liquidity facilities stop being emergency tools and turn into standing features of the landscape. Balance sheet expansion shifts from a crisis response to a background necessity. Consider the sheer scale of this problem. With roughly $9 trillion rolling in a single year, even a modest policy misstep has consequences. A failed rate cut, or a delayed auction, or a disorderly funding market can translate into tens of billions in additional annual interest expense almost immediately. There is no time buffer left. There is no long runway for the pilots to use. This dependence also narrows all future options for the state. Inflation expectations remain elevated, which keeps the long-term yields resistant to change. That blocks the traditional escape route of refinancing into decades-long debt at low rates. Without that outlet, the system is trapped cycling short maturities while leaning harder on policy tools to suppress volatility at the front end. Those tools are finite in their power. Yield curve control and expanded asset purchases and regulatory pressure on banks to absorb issuance are not neutral actions for a society. They concentrate risk inside the financial system and blur the line between monetary policy and fiscal support. Each intervention solves a short-term problem while increasing the long-term fragility of the nation. The danger compounds quietly while the public is distracted. Markets adjust to the presence of intervention, and they begin to price its absence as the true risk. Confidence becomes conditional on the next press release. Stability becomes performative instead of real. The system works, but only as long as everyone believes the policy backstop will always arrive on time and at a sufficient scale. This is not a liquidity crisis yet. It is a credibility exposure for the authorities. The debt structure assumes uninterrupted policy effectiveness in an environment of persistent inflation pressure and rising geopolitical risk. That assumption is doing all the heavy lifting for the global economy. Once a system requires constant intervention just to function, then failure does not announce itself with a single dramatic event. It emerges when optionality disappears. Failure happens when policy no longer has room to surprise or delay or retreat from the market. This leads to the final realization for all of us. If debt can roll forever, but only through continuous support, then survival no longer equals health. It equals endurance. And endurance by definition is not the same thing as recovery. Once dependence becomes permanent, the outcome is no longer a choice between collapse and survival. The system has already chosen a third path for the future. That path is continuous rollover without any final resolution. This is the end game that most people miss because it does not look dramatic on the news. It looks functional and normal to the casual observer. The debt does not need to be paid down to persist for another century. It only needs to be refinanced endlessly. As long as trillions can be rolled at the short end, the machinery keeps moving forward. Auctions clear and markets open and payments go out. On the surface, nothing appears to break. That is precisely what makes this stage of the cycle so dangerous. A system built on perpetual rollover cannot heal because healing requires the luxury of time. Long-term refinancing requires stable inflation expectations and investor confidence over decades. That window of opportunity is gone with inflation risk embedded and long yields structurally elevated. Locking in 30-year funding would hard-code higher interest costs for an entire generation. So the system avoids the cure. It chooses delay over a fix. Each year, more debt compresses toward the front of the curve. Each year, policy becomes more central to basic function. Interest expense does not explode suddenly. It hovers and stays managed through rate adjustments and liquidity tools. Deficits do not vanish from the ledger. They are absorbed through constant issuance. The debt does not resolve itself. It accumulates closer and closer to the present moment. This creates a quiet transformation of our society. Fiscal policy stops being about making choices and becomes about performing maintenance. Monetary policy stops being about economic cycles and becomes about systemic support. Growth is no longer required to reduce the debt. It is only required to prevent panic in the streets. Stability becomes the ultimate goal instead of improvement or prosperity. The numbers will keep growing every single day. $38 trillion will become $42 trillion and then $45 trillion. The absolute size stops mattering because the structure has already dictated the final outcome. As long as the refinancing works, the system survives another day. But survival under these conditions means that fragility is now permanent. There is no single breaking point in this model. There is no final auction failure that ends the world. There is no dramatic default on the news. Instead, there is a slow and painful erosion of flexibility. There are fewer policy options and tighter timing and smaller margins for error. Every future shock hits a system that is already operating at full intervention. This is what it means when debt can roll forever but can never truly heal. The danger is not that it ends suddenly one morning. The danger is that it does not end at all. When a financial system reaches a point where it cannot recover and cannot reset and cannot stop, then the problem is no longer about the debt. The problem is about time running out for all of us. If you want to understand the true gravity of this situation and how it will define the rest of this decade, then subscribe now to stay informed as the wall approaches.